What is going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we are going to be taking a look at Nike stock because this stock has had a tough year. At late last year, this stock reached $122 a share, and now we are down to $76 a share. In the last 5 years, this stock is down 14%. So it's just been a rough couple of years for Nike. I remember when they came out with the news that they weren't going to be going through Foot Locker anymore. They were going to try to prioritize selling direct to consumer. And I feel like ever since around that time, just things have not been good for the stock. So as you can see, I have 35 shares at an average cost basis of $75. I feel like this is probably the bottom for the stock. We'd have to get some really bad news to come out to see the stock drop more. But really, as soon as we get some good news to come out, this stock should shoot back up and we should see $100 plus sometime probably in 2025. If we want to look at like the P/E ratio for the stock right now is 21 times earnings. And in the last 10 years, you can see that the stock normally trades higher than that. It normally trades like 25 to 30. So this is very cheap for Nike stock. And if we even look at, let's see what Yahoo has it at. Yahoo has their forward PE ratio at 27, which is okay, so pretty much the same as what it's been last year. If we want to look at what analysts have them doing for next year in EPS, so the main problem was that this year's earnings went down, right? 3.7 to 2.8, but the next year it's expected to jump back up to 3.3. And let's see, that would put the stock at a 23 price to earnings. Forward price to earnings for 2026, well, according to their calendar, they're 2026, which is actually next year. So let's say next year, you're paying 23 times earnings today, which is very cheap. Okay, that's pretty cheap. So I just feel like is Nike really? I mean, the hype for Nike products might not be the same right now as it's been in the past at a lot of times, but that doesn't mean that the business is suddenly just going to go under or something. So I mean, Nike has been around since let's see what they were founded 1964. They've been around a long time. Okay, so they've been through lots of different things, and they're still here today, and they're one of the biggest players in their industry. So revenue the last 5 to 10 years has grown pretty consistently at 5 to 6%, right? It's not a growth company, but at least it's consistent. Every year they put up good numbers, and I shouldn't say good numbers, but they put up usually consistently growing numbers. So that's good for revenue. Then we get to net income. Net income, we're looking at $5.7 billion for last year. This one has a little bit more fluctuation because when you have weird expenses and stuff that come up, that can mess with your bottom line. And so that's why you do have dips like this sometimes, and how like we've had in the last 12 months, their earnings are going to go down. But really, let's see. So last year they did 5.7 billion, and that was off of 51 billion of revenue, right? So that's roughly what? More 12% profit margin or so, right? The good thing I really like about this is they have kept increasing the dividend, and that's really good. Okay. Shares outstanding has gone down. That's also another very good thing. We're looking at ROI, ROC numbers of 24%. That's solid. Okay, no complaints there. If we now their balance sheet though, the balance sheet has not been too good. They're not growing equity, and if we want to look at their ratio of cash to debt, we can see that the debt is slightly higher. And it's really not bad. I shouldn't say it's bad. It's just slightly unhealthy. But as soon as they have a good year where they have a good amount of profits coming in, then they can start paying off that debt and it shouldn't be a huge issue. But the balance sheet is still not in a solid position. As you can see, the equity has not been growing like it should. It's been fluctuating. We did have it jump from 12 to 15, and then now it's down to what? 14.4. So not phenomenal, but not horrible. Everything about Nike right now is kind of just mediocre, average result, really. How I said the two things I'm happy about are shares outstanding are going down and dividends are going up. That means there's still some consistency with cash flow and with balance sheet and management to where they can keep those two things solid. That's good. Um, but we need to see a little bit more. I don't want to say growth in revenue. I mean, we need to see a little bit of growth in revenue, but 5 to 6% is pretty much good enough. That's what you're going to expect with a company like this. But net income needs to be consistent, right? So they need to fix their problems of whatever happened with Foot Locker, however they want to distribute or wherever they want to sell their products at. They need to realize what they did and come up with a better solution and get some new management or something in there to fix this. But with that being said, I just feel like there's probably an 80% chance that this stock goes to $100 next year. There's probably a 20% chance that this stock goes to $65 next year, let's say. So that's the way I look at it. It's a lot of bad news and bad sentiment has been priced in already. Back in the day, this stock used to be 100 and what, $77 a share. Okay. And I mean, even in, we're talking in the COVID pandemic and in the crash of 2022, we're below those valuations even in those times. So a lot of bad news has been priced in. I just feel like it's sooner or later they're going to come out with some sort of good news, and that'll push the stock up, and it should start, recovering, and hopefully we'll see $150 or something like that at some point. But that is my analysis for Nike stock. Thank you guys for watching, and I will see you in the next video.